Hello, everyone. Good afternoon. Welcome to APREA's Asia Pacific Investment Spotlight. My name is Susan Guo. I am the host of today's webinar. To introduce myself, I am the Business Development Manager of STR, and my company, STR, is a leader in hotel performance data and provides a one-stop shop to get access to data relating to the hospitality industry. We can be of assistance to operators, developers, investors, and consulting companies. So as an association member company, I'm also very delighted to host this investment spotlight given by Asia Pacific Real Estate Association. The Asia Pacific Investment Spotlight is a two-day webinar and focus on the most attractive and compelling investment opportunities in the Asia Pacific region. The virtual events gather industry experts and throughout leaders to weigh in on investment strategies and portfolios in the context of rising interest rates, inflation, and geopolitical development. So please join us in an engaging discussion about the latest research and insights on investments in the Asia Pacific. I would also let you know that the simultaneous translation is also available during the webinar. So please look for the interpretation icon at the bottom of your screen and select the language you would like to hear. So the day one translation will be from English to Japanese. So now it is a great timing to start the first session. Welcoming remarks. So please allow me to introduce the speaker, Ms. Sigrid Ziosika. Sigrid is the Chief Executive Officer of Asia Pacific Real Estate Association. She is based in Singapore and responsible for overseeing the strategy directions, initiatives, and operations of the association across this region. So welcome, Sigrid, for the speech.
A good day to all our APREA friends. I'm Sigrid Chopra, CEO of APREA. Welcome to the Asia Pacific Investment Spotlight, our mid-year two-day virtual investor forum, which gathers experts across the region to provide a mid-year scorecard and prospects for real estate and infrastructure for the remainder of 2022 and beyond. As all of you are aware, we are navigating numerous challenges. Inflation and borrowing costs are hitting consumers and businesses. They're rising higher and faster than expected. So it's not surprising that uncertainty is in the air. Now, given this, an all-weather investing is more important than ever. The real assets industry does demonstrate that it's able to thrive historically, providing the relative stability and growth for which real estate and infrastructure are known for. Now, over the next 2 days, we have invited experts across the region to share their perspectives, with day one focusing on developed markets and day two on the fast-growing markets in the region. We hope that you find the sessions informative and insightful. And of course, recordings of the presentations will be available to watch on demand. I would also like to take this opportunity to invite all of you to our flagship event, the Asia Pacific Real Assets Leaders Congress, that will be held on November 8 to 10. And it will be held here in Singapore. This year's theme is Building the Future with a New Economy. Please check our website and reach out to the APREA team if you'd like to learn more about the conference. Thank you for being with us today, especially to all our guest speakers, and please enjoy today's investor forum.
So thank you, Sigrid, for the welcoming remarks. The next session is the Investment Spotlight Singapore, which is presented by Mr. Dennis Yeo, Head of Investor Service and Logistics and Industrial in Asia Pacific at Cushman & Wakefield, and Mr. Wong Xianyang, who is the head of research in Singapore at Cushman & Wakefield. So welcome the speakers.
Hello, everybody. With Spotlight on Singapore, we will discuss the current rising interest rate and inflationary environment and how investors could strategize and navigate this environment. We will run through what's happened in the market so far and where capital were being deployed, and the billion questions on repricing. Finally, we will touch on megatrends, which will shape the real estate environment landscape and how investors could strategize their investments. I will now turn over to Xian Yang to start our discussion. Over to you, Xian Yang.
Thank you, Dennis. Okay. So, hello everybody. Nice to meet all of you. So let's start with a quick review of the first half of this year. And look at economic indicators. The Singapore economy looks to be on strong footing. In Singapore, most safe management measures have been relaxed, and life is returning to pre-COVID normalcy. Restaurants are full, and people have returned to the office, and travel is going on and about. So across all industries, they're seeing growth, and some have surpassed their pre-COVID levels, or some are moving towards a full recovery. And this is reflected by strong first quarter GDP growth, which grew by about 3.7%, and it's expected to stabilize at about 3.8% for 2022. And this would still be higher than pre-pandemic growth rates of about 3.2%. And the labor market is tight, as you can see, right, driving unemployment back to pre-pandemic levels. And trade is healthy, with non-oil domestic exports growing by about 12% year-on-year in May. I bet this comes from a lower base, but nonetheless, it's poised to stay firm this year, despite risk, driven by recovering demand in Asia. However, downside risks are emerging. Right? Inflation has reached more than a decade high, driven by resurgent demand, and also cost-push inflation, right, driven by supply chain disruptions. And this has fueled a rise in interest rates by many central banks to keep inflation under control. As such, we expect economic growth to slow towards the second half of this year and in 2023. But that said, as mentioned earlier, Singapore is in a position of strength and is likely able to navigate the coming turbulent environment. Singapore is seeing strong capital inflows, especially into our real estate market, right? And this will support capital values. And a tight supply situation across the board will underpin rental growth, even if demand were to falter slightly. But let's go into more detail into each asset class. So let's look at the performance on a sectoral basis. So we see, there's broad-based recovery across all sectors in Singapore amidst reopening. Right, so you can see demand is increasing and recovering well amidst tight supply. And this is especially for prime logistics, which has benefited from the rise in e-commerce and higher demand from high-value manufacturers. The rents in the first half of 2022 has risen by about 5%, right? And amidst very tight supply, and this is exacerbated by underinvestment in this sector before the pandemic due to falling rents. But as more people return to work, right, so there's a lot of renewed interest in the office market, right, as it shows that the physical office remains very relevant for businesses, right? Though the role of the office has changed, to be one more for collaboration rather than heads down work. So this has led to a very broad redesign of the office, and together with ESG considerations, right, this has driven a flight to quality and fueled a rise in rents. And similarly, quality stock in the CBD remains very limited, with vacancy rates at about 5%, which is very tight, on a regional basis. And look at for the retail market, right, prime retail rents are recovering well as well, though the pace of recovery is, I would say, quite measured, right, due to a gradual recovery in tourism and also a challenging operating environment for retailers due to e-commerce and changing consumer preferences, which has also led to a continued rejuvenation and revamp of the retail landscape. Right? And now moving on to the residential market, which is a really hot market, which is this year, right? And this is due to increased demand due to Singapore's reopening, and also delays in construction, which has led to surging rents. Right? However, for investors, hefty cooling measures such as the additional buyer stamp duties have limited price growth. Also, given that mortgage rates are increasing, right, demand may slow slightly, right, and this will cap price increases in 2022 and 2023. But you can see, rents have grown really strongly, especially in the first half of this year, right, and this will support capital values in the residential market. And finally, hospitality is also recovering, right, due to increased tourist arrivals, but also this comes from a very low base. So while the percentage recovery looks really strong, RevPAR for hotels still remains below pre-pandemic levels, as the recovery in tourism to Singapore is expected to be gradual amidst zero COVID policies in China, as Chinese tourists make up about 20% of Singapore tourists pre-pandemic. Yeah. So that's for a broad overview of the different asset classes in Singapore. But let's look at the investment sales, right? What has happened so far. So with strong growth prospects, with rents and surging, right, and still there's a lot of ample liquidity in the market, due to a lot of capital raised in the last 2 years. Capital is flowing strongly into the Singapore market. Institutional investors are actively investing, with the likes of AW buying a decentralized office tower, and also KKR buying offices in the CBD. Right, commercial investments have made a strong comeback, right, and dominated in the first half of this year, with total commercial investment sales reaching about 10 billion, and this was driven by a slew of large office deals in both the CBD and decentralized markets. Investors remain optimistic about the office market, given sustained demand from finance and tech firms, and also really very limited supply. Right? And as uncertainty in the global economy ensues, right, there's a flight to safety, as investors are keen on assets which can deliver stable income. So within the office market, driven by ample by capital, right, and also growing rents, right, yields in this market can transact at very low net yields, right, at about 2% for freehold or 999-year leasehold offices. As such, some investors are looking at value-add or opportunistic plays to boost demand, to boost returns, and also to leverage on government schemes which encourage redevelopment into mixed uses. And so following the commercial market, the residential market looks really resilient, right, in terms of investment sales, and is poised to exceed 2021 levels. Given rising residential prices and rents, right, market sentiments remain positive despite cooling measures and rising interest rates. Unsold developer inventory remains very low as well. As such, developers are still looking to acquire land, and land prices are in an uptrend as developers bid competitively for well-located small to medium-sized sites. Larger sites face higher risk and a more cautious attitude, right, due to the additional buyer stamp duty timeline of 5 years, where developer needs to sell all their units within 5 years of site acquisition or face higher taxes. So next, looking at the industrial market, right, industrial properties, right, remains very highly sought after, but total industrial transaction volumes tend not to dominate due to their lower relative prices compared to the commercial and the residential market. So this is also a function of average shorter leases for industrial properties, and also very limited institutional grade industrial assets for sale. And also the industrial asset class remains relatively unfamiliar to many institutional investors given the high operational nature of this asset class. But as mentioned, we see increasing interest from institutional investors, given a very positive long-term outlook for industrial properties due to prevailing megatrends such as e-commerce, right, digitalization of businesses, and also increased focus on life science. And this would drive demand and rents over the long term. Right, notable deals over the last 2 years include the acquisition of Startup Green, right, a high-tech factory. Right, this was bought by PAG, right, Emirates by AEW, and Sandcrawler, which is a business park development located at One North, and this was acquired by Blackstone. Right, so institutional investors are increasingly looking at this at industrial assets, right, and this would bode well for capital values and also yields. Right, and for hospitality, we see nascent recovery as investors anticipate the recovery of tourism as borders reopen. Right, recent investment deals include the sale of Esso Singapore, a hotel in the CBD, right, to Viva Land Investment and Development, a Vietnam-based developer. Yeah. So finally, let's look at how will rising inflation and interest rates affect the Singapore market. Right, I think that's the question that everyone is asking, right? Whether will there be repricing risk, and whether can real estate perform as a strong inflation hedge, right, for investors. So historically, rising inflation bodes well for properties in Singapore as landlords are able to increase rents faster than inflation. So looking at the chart on the left, which tracks average income returns and capital returns over the last 5 years, the total returns of properties have been relatively strong, right? And this is driven by compressing cap rates and rising rents. So as more capital pours into the Singapore market, right? Total property returns have been about 6 to 9% annually on average, and has strongly outpaced inflation over the last 5 years, which was on average was about 1%. But given current developments, such as the Ukraine-Russia conflict, right, and the ongoing supply chain disruptions, inflation could stay relatively high over the next 5 years, and we anticipate this to stay about 3%. So given current developments and also economic uncertainties, we are unlikely to see the same inflation spreads like what we saw previously, right, where inflation was only about 1%, right, it's gone to 3%, because really a good part of current inflation comes from cost-push inflation, which would provide lesser room for landlords to increase their rents. But in the past, a lot of inflation was driven by demand pool, which allowed landlords to increase their rents. This time, where a certain portion is due to cost-push inflation, due to supply chain disruptions, right, the increase in rents would probably not be as much as before. But nonetheless, for a big picture basis, right, real estate is still generally expected to beat inflation and continues to be a very strong hedge, against inflation. So that said, will we see repricing the markets due to rising interest rates, and also due to a lot of due to headwinds on the horizon? Well, for sure, rising interest rates will put upward pressure on property yields, right, as demand will be impacted due to tighter financing, right, and investors will demand better risk-adjusted returns. But in Singapore, we believe such opportunities will be relatively limited as the broad economy looks steady, right? Singapore is seen as a safe haven, right, and there's still active investments coming into Singapore, and also asset owners remain very well capitalized, and it's a seller's market in Singapore, so there are no hurry to sell assets, especially those that are in limited supply, and furthermore with growing rents. So in our opinion, even as interest rates increase, right, the continued growth in property rents will stabilize net property yields, which have been falling over the last 5 years. Looking at the chart on the right. So these show net yields for across the asset classes, with exception for the residential, which reflects gross yields, and also do not reflect transaction costs such as ABSD. Right? So assuming yields remain stable, capital values will continue to increase. as rents grow. As such, investors will still be keen to deploy their funds into real estate in anticipation of continued capital growth. Right? And based on historical data, right, offices and residential have shown the strongest capital value growth. And we anticipate this trend to continue as liquidity continues to chase limited assets in the market. But given current prevailing market trends, industrial may surprise on the upside in the future, though asset selection is very important for this market, given the high level of operational work for industrial assets. Now let me pass this back on to Dennis, who will talk about the longer mega trends and how investors should position or strategize their portfolio for the future. Back to you, Dennis.
Thank you, Xian Yang. While rising interest rates and inflation will affect real estate investments over the short to medium term, investors should align their portfolio according to the longer term trends to capture the first mover advantage and reap better returns. Let me run through a few mega trends that we see happening over the next decade or so. One clear trend that we can see is the building obsolescence that will accelerate. Rising energy costs, a focus on sustainability from large corporates will drive demand towards quality and sustainable building. Already with many corporates pledging to go carbon neutral in the future, we have seen some tenants incorporating sustainability factors into their site selection criteria. Also, the segmentization of property zoning is blurring. So due to changing business needs, mixed developments that actually can incorporate flexibility will be much better to cater to future demand. As such, owners sitting on aging assets will actively start investing and refresh their asset to cater to the changing real estate demands and to prevent their assets from getting stranded. This will spark a wave of capex, which will last over the next decade. So we do see strong potential to reap first mover returns for investors willing to get their hands dirty and participate in value add and redevelopment opportunities. This could be by way of a joint development or acquisitions and so on. Another key trend is the changing ways of work. Business needs will evolve and change due to changing work styles and technology. And this will shape the way users consume real estate. For example, the mall is no longer just a place to shop, but it's now evolved into a community hub. Real estate demand has shifted from retail spaces towards logistics due to the rise of e-commerce, as everyone knows. E-commerce now moves into several verticals, including groceries and food. And this, to a certain extent, have fueled interest, for example, cloud kitchens, a new business as well. Another is the ongoing digitalization of business processes, which has driven demand for data centers. As new technologies such as AI and IoT becomes more mainstream, lots of data will be generated and will fuel data center demand. Finally, the rise of the sharing economy, fueled by better technology, will lead to interesting use cases for real estate, and that will drive efficiency. So investors should watch these trends closely. Continuing on, people are Singapore's most precious resources, and we have to ensure that the real estate is right purpose for their needs. Millennials, born between 1981 and 1996, currently dominates the workforce. And looking ahead, we have Gen Z, a digital savvy demographic that were born between 1997 and 2012. They will start to enter the workforce over the next decade. This demographic is extremely familiar with technology. and are very aware about sustainability and diversity. And they also have a very strong emphasis on well-being, and flexibility. So future buildings need to be designed with this in mind. That said, we of course cannot ignore retiring baby boomers and Gen X, which I fall into. And as they have ample spending power and able to work longer and have benefited from rising property prices over the past 2 decades. So real estate can cater to this diverse group, will benefit strongly. On that note, the population in Asia Pacific is aging, though at a different pace across cities. As the population ages, the birth rate falls, productivity will inevitably fall. As such, there will be a huge war for talent among cities, as everyone will seek to improve productivity by attracting young talents. Cities that are able to implement policies well and be able to attract talent will outperform. I would say ASEAN is a key market in the future, with rising wealth driven by regionalization of supply chain and investment from the Western countries, including Japan and China. This is a huge potential for everyone investing in real estate. ASEAN is home to over 660 million people, and with a high proportion of young demographic, this demographic windfall, combined with economic expansion, will power the region forward in the decade ahead. So there will be a lot of investment opportunities, not only in Singapore, but the wider Southeast Asia region as well. Finally, we see increasing demand for alternative assets amidst tight yields and crowded market for traditional assets. New emerging concepts such as co-living will become more viable, fueled by demographic shifts with change in the consumption patterns, as well as advances in tech, which drives productivity and lower the operating costs. Now let's look at opportunities. Over the next decade, the built environment will face increasing obsolescence risk, driven by increasing carbon tax, sustainability focus, and changing consumption patterns and technology. Already, more investors are looking to value add and opportunistic investment to prevent their assets from getting stranded. Use the word stranded in this, and also in the search for stronger returns. Now, due to the tighter financing environment and increased caution, capital raising in the region has actually started to slow. So we see opportunity for well-capitalized investors to enter the market and gain first mover advantage, either to redevelop or asset enhancement in a market where supply remains pretty tight. Given sustained office rental growth, aging buildings in the CBD continue to show promise. And for eligible buildings, developers have flexibility to pivot to residential market due to the CBD incentive scheme given by the government. For industrial, there's a strong flight to quality, and investors should look out for opportunities in the sub-optimized but well-located industrial buildings near to MRT stations or close to major commercial nodes. For retail, consider older malls which are close to residential area that can be revamped to cater to e-commerce and embed smart FM to lower the cost of operations. The broad Singapore residential market continues to be supported by rising rents and prices. Mass market and city fringe properties have dominated demand due to strong local demand. However, Singapore's prominence as a wealth hub, which sees strong wealth and capital inflows, the high-end market could be the one to watch. For hotels, investors can look for AEI opportunities, especially in aging hotels, to drive down operation costs or to look at it potentially as repurposing into co-living. Next, let's talk about the changing work trends. The changing work trends will fuel a flight to quality as roles of certain assets will evolve. New models in the sharing economy will emerge as companies right-size their footprint in the office and industrial market. Flex space will continue to be in demand for both office and industrial users. And for manufacturing, we could see increased sharing of facilities as technology, connectivity gets more advanced and allows that. Malls that can blend online and offline experience and cater seamlessly to deliveries will see strong demand. The entire logistics will need to be seamless, from parking to pickup to delivery. So future malls needs to be designed with this in mind. Residential development will need to cater to work from home trends and provide workspace within the development. Common business rooms or study rooms with phone booths to take calls can actually be provided as an amenities for residents. For hotels, there is opportunity for repurposing for co-living given the fast rising rents in Singapore. Given shifting demographics, real estate must cater to for future consumers, and investors must understand what they want. Millennials and Gen Z want good reasons to come to the office. So the office must be an attractor to draw talent and should cater to different styles of work, from collaboration spaces to quiet rooms for serious heads down work. Gen Z are also digitally savvy and have grown up with e-commerce, and this will fuel logistics demand. The mall is a community hub that needs to meet demand for all generations. To curate a multifaceted experience, scale is important. So larger malls are better able to execute this and enhance placemaking. Millennials and Gen Z cares about sustainability. So homes and hotels need to incorporate this. On a macro scale, ASEAN will be a key driver for the global economy due to a relatively youthful population and emerging middle class. ASEAN would also benefit from regionalization of supply chain and increased investment flows from slowing mature economies, including the Western countries. That said, not all cities are equal. And in relation to demographic shifts and an aging population, there will be a war for talent. And cities that continually maintain and enhance their livability will do well as talent will gravitate there. In this regard, Singapore is in a position of strength in Asia. Finally, given continued interest in real estate in Singapore, especially in the office market, where yields are so tight, we see opportunities in alternatives. Co-living is a nascent segment currently, but that's gaining traction. And also, given our housing policy, which favors home ownership and the continuing steady supply of new HDB flats, the business model and risk management of co-living business are therefore very important. Industrial, with its myriad of property types, including manufacturing, production of factories, research, biolabs, logistics, warehouses, cold store, ambient stores, dry stores, self-storage, etc., should present ample investment opportunities. However, when you want to talk about Singapore, it is not exactly that case. Majority of industrial lands in Singapore are owned, managed, and controlled by JTC. And there are strict restrictions and regulations and criteria which investors will have to follow and in many times get approvals for. But institutional investors remain unfamiliar with this asset class in Singapore. Right? So actually my best advice here really is to seek the help of an experienced industrial property consultants like us, Cushman and Wakefield. Still, though limited, opportunities are available in the private industrial lands and buildings. We do see potential in private freehold or long leasehold industrial assets, which are not encumbered by JTC rules and restrictions. The values of such land can only go up due to their very limited supply and Singapore increasing industrial and business demand. This brings us to the end of our presentation. We're happy for further discussion after this event, or if you have questions, contact me or Xian Yang at Cushman & Wakefield. Thank you for listening.
Thanks to speakers for the great speech. So as mentioned, it's very glad to see the broad-based recovery in Singapore, especially in some key sectors like logistics, retail, private residential, and also hospitality section as well. So, and also great to hear some mega trends like the rise of Asian and the rise of alternative assets. They are providing new opportunities to this market. So now let's turn to another vital investment market and move to the next session, Investment Spotlight, Hong Kong. Welcome, Mr. Simon Smith, joining us and present at this session. Simon is the Regional Head of Research and Consultancy, Asia Pacific at Savills, and has over 25 years of experience of Asian real estate consultancy. So look forward to the spotlight.
I'm going to give a quick presentation on the Hong Kong property markets. I'll focus on the office, industrial and retail sectors. Hope you can all see that okay. And we're going to begin with a look at the office leasing market, which has been buffeted by a number of different factors over recent years. And just looking all the way back to 2019, we saw a period of, actually prior to 2019, we saw US-China trade tensions begin to mount. 2019, we saw social unrest. And then of course from 2020, we saw COVID, which knocked the market back again. Most recently, some of the more micro trends that we're seeing in the market is really a pause in mainland corporate expansion. And that's not surprising given the extent of city lockdowns in China and the fact that the border is still closed. That's also hitting the IPO pipeline, which traditionally generates quite a lot of business for the Hong Kong office market. Cryptos as well that have helped drive the market over recent years have had a pretty torrid time so far this year, with declines of 50 to 60 or even 80%, the case of coins like Bitcoin and Ethereum, and we've even seen full-scale busts as well. One positive in the market currently is medical groups. There's expanding demand for medical services, and there are lower rents on offer in fringe locations, the sort of areas that these types of surgery tend to favor, and that's giving some small relief to the office market. But very generally, given that we have quite a substantial pipeline of new supply, pre-commitment levels have been quite low. Places like 2 Taikoo Place, the Swire development down in Taikoo Shing, and 11 Skies office tower have actually bucked the trend and have both seen quite strong levels of pre-commitment, but elsewhere take-up's been pretty weak. At the same time, a lot of the new supply is being delayed by all sorts of COVID-related issues and the problems getting sign-off on various aspects of development, but also problems with getting goods over the border from mainland China, predominantly for construction and fit-outs. So looking ahead, we see probably further declines. We'll look at forecasts a little bit later. The reality is that Grade A office rents are already off around 30% from their peaks in 2019. And that central premium, the CBD premium over the rest of the market, has reduced. And these this sort of softening is expected to continue. If you look at vacancy, never mind the new supply, if you look at existing vacancy in the market at the moment, available space, we're pushing up to 10%. That's around 6 million square feet, so quite substantial amounts of availability historically. And that is impacting elsewhere in the market as well. So values have come off since 2019. At the moment, they're sort of bouncing along the bottom. We're seeing relatively low transactions volumes and a general air of caution. Interestingly, the market pushed back a little bit after the fifth wave, which we experienced in the sort of January, February time. There was a brief optimism as we pulled out of that, but subsequently volumes have fallen back again, and there really is a widespread feeling of caution in the market, sentiment not so positive, and that's reflected, as you can see, in both transactions volumes and values in some of the more popular strata title buildings in Central, where quite clearly things have come off. Looking ahead, we're seeing elevated levels of new supply, about 8 million square feet between now and 2024. Remember, that's on top of the 6 million square feet of vacancy that we saw earlier. A lot of that supply initially over this year and next will be in fringe locations, but subsequently will be focused a lot more in core areas. There's also a new focus in the type of supply that's coming to our markets these days. I think this reflects a change in workplace expectations. There's a lot more emphasis on things like amenities, health and well-being, for example, gyms, coffee shops, etc., and also on sustainability. Greening of buildings has become very important, green certification. And this is something that the landlords of new developments are very fully aware of. And there's two good examples here of buildings that are listening to the market in that respect. And landlords here are generally becoming more aware that they're not going to be able to lease or indeed sell properties unless they are meeting the highest standards of sustainability. And that tells me also that looking ahead over the next few years, a lot of the older stock, which is not ESG compliant, which is not delivering the required level of amenity or well-being, is going to have to be either retrofitted or redeveloped. And we're talking about between 25 and 30% of stock, depending on whether we're in the grade A or the grade B market. So that's quite a big turnaround for this market, and it's definitely a trend to watch over the next few years. That ESG regulation now beginning to pinch quite a bit, and will have implications. Forecasting rents, we've got a best case and a worst case scenario here. We think rental declines will probably continue through into 2024. It's difficult to see any upside prior to that. Demand levels generally are fairly weak at the moment. As I said, we're not seeing the major levels of activity from the mainland firms, and at the same time, a lot of international MNCs, the bigger banks, are reweighting out of Hong Kong into places like Singapore or Dubai, and that's being partly driven by the lack of an IPO pipeline, but also by our very strict quarantine measures, and until recently the flight bans as well, which were being instituted on airlines who brought in infected passengers. This has made Hong Kong a very difficult place to operate out of as a regional hub, and has resulted in we've called it an expat exodus. It's really an exodus of both expats but also local professionals as well, some driven by the political environment, and the expats driven more by the economics of the situation. Prices are always rather harder to forecast, but we do see declines ahead where interest rates are rising now, and the rental outlook is as soft as I've just mentioned. It's difficult not to see price forecasts or values generally coming off further. At the moment, we feel there's probably about a 20% bid-ask spread in the office market, and we're going to see a few months here of very low volumes, I think, and a prevailing air of caution. I'd like to turn now just to look at the industrial market. You know, we've seen boundless optimism over recent years. Can this possibly continue? You know, what are the sort of variables that impact this market? Well, all of them at the moment flashing red. Quarterly GDP growth is down. Retail sales are shrinking. Imports and exports really haven't bounced back much. And cargo throughput equally is looking pretty subdued. So on the face of it, really the market isn't offering much for logistics. But then you turn to look at things like e-commerce, particularly e-commerce with China. This is a factor which could well help to drive any rebound in the market over the next few years, and has been a real backbone for the sector recently. I do just want to clarify a little bit about what we mean when we talk about industrial. I think we've had a tendency here in Hong Kong just to talk about either broadly the industrial market. And in actual fact, it's much more nuanced than that. At its simplest level, you can break it down into factory space, a lot of it old factory space and no longer used for manufacturing, to sort of general warehousing for storage. And these days, we've begun to break that down a little bit more into modern warehouses and general warehouse stock. You can see it's about there's about sort of 25 to 30 million square feet in each category. And of course, the modern warehousing become increasingly significant over time. But really beyond that very simple categorization, I think you can really disaggregate this market into old flatted factories used for storage. Some are used as offices, even some for basic manufacturing and workshops, and some even for retail and services. You've also got the general modern warehouse distinction, but also creeping in, you've got industrial offices, the so-called new industrial premises. You've got data centers, also classified as industrial, and things like cold storage and self-storage. So it's a much more nuanced sector than I think we've seen before. And you have to be a little bit careful if you hear someone generalizing about industrial in Hong Kong, pin them down a little bit about what sector they are actually referring to. If you look at warehouse stock levels for example, they're up around 5 million square feet between 97 and 21. A lot of that about the redevelopment or the development of modern warehousing. But if you look at flatted factory stock, that shrunk by around 19 to 20 million square feet over the same period. And the main attraction there has been redevelopment or retrofitting for office use, for so-called new industrial uses, or for others, anything from data centers to hotels and medical centers. You can see here, this is just something to do with the land lease, but when we talk about new industrial buildings, I've shown you some examples here. These are very popular as a target for plot ratio relaxations, and really office buildings in all but name. What else in the sector? Well, vacancy continues to trend down, as it has done over the duration of COVID, actually. You can see vacancy peaking in around 2020 and falling fairly steadily ever since. Rents as well have been pretty resilient over the period. Values at the moment drifting a little bit. And, you know, whilst we've seen substantial yield compression in the sector, you know, yields at sort of 3.5% are still ahead of residential, office or retail, for example. Volumes in common with everybody else, despite a bounce post fifth wave in the first quarter, with seen things drop back a little bit, most recently in June, as a sort of caution has prevailed and people have worried more about the prolonged border closures with China, the city lockdowns in China, and the possibility of a global or certainly a G7 recession. Looking ahead, there's plenty of supply in the pipeline next year, most of it in the warehouse market, and most of it considered modern logistics facilities. In fact, if we look at that warehousing, or go down, as we say in Hong Kong, if we look at that new supply, it's entirely focused on Hong Kong International Airport over at Chek Lap Kok and in Tuen Mun. In the airport, it's really accounted for by one major project, which is the Alibaba facility, which is around 5.3 million square feet. Data center development has been focused on areas like Fotan, Chenquano, and in Chunwan as well. And you can see, just focusing on the warehouse supply ex data centers and cloud factories, a lot of that has been either pre-committed, and this is the Goodman development, Westlink in 2022, or will be owner occupied, which is the Alibaba space out at the airport, which I referred to earlier. Looking ahead, again, very common themes here, the dislocations caused by the Russian Ukrainian war, by COVID, by rising interest rates, by all sorts of major disruptions out there and major uncertainties, which are really affecting all the key property sectors at the moment. But one thing I'd say, there are some positives still lining up nicely in logistics. That demand from e-commerce is still positive. A lot of the new facilities have been taken up, so that short-term overhang no longer really exists in terms of new supply. And that GFA concession, where it is possible to convert industrial premises into other uses, continues. Has actually been extended by government for another 3 years. I would also encourage anyone looking at the sector to focus very much on transport infrastructure and new development areas. We see positive rental growth going forwards. As I mentioned, values should follow hot on the heels. But looking at infrastructure, now it's all about cross-border infrastructure, road and rail. You can see I've outlined most of it here. Large, significant projects already complete. The Hong Kong-Shenzhen Western Corridor, for example, in 2007, or the Liantianheng-Yunwai boundary crossing in 2020. Really major parts of cross-border infrastructure there. But it's also about the new development areas. We've heard there's a lot of talk about the Northern Metropolis from government, significant development initiative in the Northern New Territories. And part of that is this greater integration with the Greater Bay Area, which should become a major demand driver across most of our markets, but particularly the logistics market over the next few years. You can see as part of that strategy, there are a number of different NDAs that compose the Northern Metropolis. If you look, though, at the sort of southwestern corner here, you'll see Hongshi Q in Hachun. That perhaps is probably the most significant of the NDAs in terms of logistics, because it should yield around 30 million square feet of logistics and warehouse space through to completion in 2037, 2038. So quite a long-term project there and quite significant for the sector. Turning lastly to look at Hong Kong's retail market. We saw early signs of recovery, or we thought we did, in 2021 and early 2022. But since then, a number of the fundamentals have fallen back somewhat. GDP growth took a hit in the first quarter as the fifth wave hit Hong Kong and the mainland lockdown. Unemployment began to rise again, having shown some positive trend through 2021. And domestic retail spending, again, positive out to 2021, but perhaps backtracking a bit in the early part of 2022. You hear a lot about F&B. People still like to go out and eat, even in these sort of troubled, COVID-riddled times. And F&B has actually held up reasonably well. Tourism receipts have come off a bit, but the number of licensed general and light refreshment premises has been gradually increasing. And you'll see in a lot of retail malls here, F&B has been one of the key demand drivers over recent years, even if things like luxury retailing, for example, which has been very much driven by mainland tourism, has been in decline. We've seen this growth in sectors that are far more driven by domestic consumption expenditure, which has been key. And we were relying heavily on that. The fifth wave early this year meant more strict measures to contain the outbreak and also knocked back that domestic consumption. I'm still a little bit concerned looking ahead at where domestic consumption may take us. As I mentioned before, there are a number of headwinds currently affecting the local market. Things such as slower growth, for example, higher interest rates, which could translate into higher mortgage rates, inflation, volatile stock markets. This all counts against robust domestic expenditure, I think, going forwards. But we'll have to see. One thing, rental declines, and they've been declining steadily over the last few years, really peaking in around sort of 2014. Rents have been on this pretty steep decline now, and in many markets are really back to 2003 levels. It was in 2003 that we introduced the individual visitor scheme here, which allowed mainlanders to come into Hong Kong in large numbers, and proved absolutely transformative for the retail market. That has begun to unwind as mainland tourism has declined, as we've seen periods of social instability here, as COVID has affected us, as the renminbi has weakened, as the anti-corruption drive has kicked into gear in China. All these things have really taken off tourists, have really taken the edge off tourism expenditure in Hong Kong, and translated very directly through into rents in both shopping centres and prime high streets as well. We like to think that shift has now taken place, and that what we're seeing currently is rents bumping along the bottom, but we're still waiting for that white knight really to take us on to the next step. And who knows, once mainland tourists do begin to return in numbers, we could see another multi-year run-up as the market is refreshed and luxury demand returns. I think most luxury retailers we spoke to probably don't see us returning to those giddy days of 2013, 2014. But perhaps we could get within, perhaps we can get within 20, 30% of those sort of levels. Would be quite happy. All is not lost in the retail market. There are areas of opportunity. There are growth areas. I mentioned the Northern Metropolis earlier, where we've seen significant amounts of planned residential development, and alongside that, retail supply. There are areas of other areas of population expansion which are attracting middle-class households, and again, there'll be spending power there, which can be exploited. And also, you can expect, once tourism does return, the first wave will probably be an overnight visitors coming more directly across the border and shopping, probably in the Northern New Territories. So that will perhaps be the first area to really feel the benefit of a return of mainland same-day visitors. It'll only be subsequently that we see the overnights coming in from central and eastern China, who will then focus more on the luxury market. Looking in terms of new completions, most taking place in Kowloon and the New Territories from here on in, and no surprises there given the lack of developable floor area in the core areas on Hong Kong Island. And projects you should be looking out for, some of the major ones, and they are quite significant. Airside, for example, by Nan Fung Group. That's actually out at the old airport. Twin Towers, the Kai Tak Sports Park, another development out at the old airport, and Kai Tak Airside, the Hopewell Mall extension, the YAPM, and the Social, as well as Kwun Tong Town Centre, 11 Skies and Central Harbour. So some major projects there which are going to have quite a transformative impact on their own local retail landscapes, and are close to letting. The retail numbers are pretty simple. It's all about a rebound in mainland tourists. That will be our transformative moment. As yet, that is pushed further and further away. We hope maybe next year we may see high numbers of arrivals, but difficult to forecast. For now, there's local consumption is an important driver. That is enjoying a little bit of a rebound as government pumps its voucher scheme into the economy, and that has a fairly direct impact into retail, but is only a short-term salve for the market. I'm more concerned about slower growth, rising interest rates, rising inflation, and their possible impact on domestic spending here. Forecasts, we're hoping for a turnaround, but not until maybe 2020, late 23, 24, contingent entirely on mainland tourist returns, which are so very difficult to forecast. And that's where I'd like to conclude. Thank you very much.
Thank you. Thank you, Simon, for your spotlight on Hong Kong market. Like you mentioned, the office leasing market in Q2 this year has slowed down due to various reasons. But offices in central locations are still attracting the investors, which is really good news. And thanks for sharing the rental forecast for grade A offices as well. And let us know the upcoming trends in next 2 years. So it's a truly an informative presentation and also includes a market outlook for logistics sectors, industrial supply, and retail market. And great to see the early recovery sign from late 2021 until now. Oh, thank you. So next, please join me moving to another investment market, investment spotlight, Japan. The speaker of this session is Mr. Tetsuya Kanoko. Mr. Tetsuya is a managing director, head of research and consultancy at Savos, Japan. He is responsible for all research publications in Japan and consulting services to domestic and international investors and market players across multiple asset classes. So welcome.
Good afternoon, everyone. My name is Tetsuya Kaneko, head of Savos Japan research team. Today, I'm honored to talk about Japan real estate market outlook, specifically the office and residential section and post-pandemic overview in those two sectors. And finally, I would like to touch upon prospect toward 2030. So the time is limited, I will start. And if you go to page 2, this is about macro market or summary. So about macroeconomy itself, so far looked good, especially before the crisis Ukraine. Or for example, listed company in Japan announced net profit increment of 36% year on year in the recent fiscal period ending this March. Which looked very encouraging or great recovery after the pandemic. On the other hand, they also announced at the same time a very small amount of net income increment this fiscal period only 3% because of supply chain disruption, also the price increase in raw materials. So the situation currently still looks good, but quite a lot of uncertainty, and global economy is likely to slow down. That's the issue for macroeconomy. About policy, Japanese politics remains pretty stable. And we have election in early July. After that, there is no major election or 3 years time. So it means if the current coalition party wins, they can do some reform, for example, like to consider the resumption of nuclear power energy and also welcoming more inbound tourists. Those two should be pretty promising policy from real estate point of view, because currently Japan is suffering from the weakening currency. That's because basically quite a lot of import of energy and also inbound tourist spending became almost zero from more than 5 trillion yen. So after those policy is implemented, fiscal condition should significantly increase, which is definitely good for real estate investment in Japan. And next, demographics. Also, demographics in Japan obviously doesn't look very promising, but before the pandemic, the increase in foreign residents offset the decline of the Japanese population. So those windfall had been suspended during the pandemic, but we will see how many foreign residents would like to come back. About lending, so lending situation is slowly and steadily increased and improved, so which is good. And interest rate may increase because of global economic situation, but so far the situation looks stable, but the current governor of our central bank, Mr. Kroder, planned to finish his term next April. So it means a lending situation may change, but we expect the change should be moderate anyway. And next, investor sentiment still very positive, but investor became selective, and some investors, especially overseas institutions with sizable AUM already, seems like they became more cautious and started to take wait and see attitude because they have some concern, inflation and interest rate hike. And about sector, so really depends on sectors. Logistics sector continue to thrive, and interest in multifamily and office are growing despite some rental collection. Those two sectors I will discuss more in detail in the later. Then go to next page, page 3. This is about real estate market summary. So here, for the sake of this presentation, I will use grade A office in Central 5 Ward. So rental decline still continues, but adjustment becomes softer and softer, and vacancy still remains loosening, but also the speed is getting slower. So it means we may be close to the equilibrium or maybe close to the bottom out for recovery, which is good sign. About cap rate, stayed flattish, pretty low. Still, if there are some investment opportunities, many investors would like to acquire. So cap rate stay flattish. But if interest rate goes up or more than marginally, cap rate may need to adjust. But so far, we don't see any repricing at this moment in Japan. About supply, most supply last year and this year has been released or filled, which is very encouraging. But we have quite a lot of supply next year. That could be a problem. But about supply, I will cover with data in the more detail later. About tourism, so finally the border was opened last month, and hopefully more and more inbound tourists will come back to Japan, which is good for the exchange rate, and which should support some inflation problem in Japan. About regional cities, still there is a cap rate spread yield between Tokyo and the major regional city, and also supply demand situation of balance, in general, better than Tokyo, especially in relative terms. But supply and demand balance significantly differs across city. So we have to look at city level more carefully. But recently, quite a lot of interesting movement in regional city. For example, Osaka welcomed the new addition in prime area in front of Umeda Station. And the building came to the market with over 85% occupancy, which is very encouraging sign. And the building enjoyed very high rent, around 38,000 pesos per month, which is top rent, and increase top rent in Osaka by almost 10%. So it means still those regional markets have demand for quality building, and also those quality new addition are transforming the city itself. That's the summary. So then I will move to specific topic. If we go to page 5, this is about pretty hot topic recently. I mean, inflation and possibly subsequent interest hike. First of all, overall, inflation in Japan, in our opinion, should be moderate. The reason is, very unfortunately, wage growth in Japan has been very stagnant and very modest for the last 3 years. So if the price increase, demand will disappear. That's why many economists also expect the CPI in Japan, or excluding fresh food, will increase, but only to mid 2% at most. About interest rate, so since inflation is moderate, the central bank in Japan doesn't have strong reason to increase interest rate itself. But the issue is the sharp contrast about the monetary policy. Now, Bank of Japan is only one major central bank who keeps loosening policy, which means and need to depreciate quite significantly so far. So that created another problem because Japan imports many things, especially like energy and also like food. So that's why those like weakening yen became kind of political issue, possibly. And that's why if this weak and continue or further depreciate, maybe interest rate need to go up to offset the impact. But as I said, after the election, government could consider the resumption of nuclear power station, which significantly decrease the import of energy, and also possibly welcoming much more inbound tourists. Those two initiatives should increase or should alleviate the pain. And overall, the Japanese real estate market continues to see sound interest from overseas investors. But in the meantime, some investors, especially overseas institutions with already sizable AUM, some of them are considering the possible negative impact of interest rate hikes in Japan, and also some of them are taking a wait and see attitude. But as I said, still so far we don't see any repricing effect. That's because even some investors become cautious. We still see so many new entrants who had struggled to acquire property recently. So they just snap up available opportunity. That's why so far pricing remains stable, and also we don't see repricing. That's the situation. Then, if we go to page 7, this is about our sector view. So for I think globally almost same, but residential logistics are very popular sector. But logistics, in our opinion, we have seen quite a lot of like signs of overheating, because logistics has been the most sought after asset class, especially during the pandemic. And competition was really fierce. Also, that's why especially some new entrants needed to buy good property at very sharp price, or bought property where the location is not ideal. And now seems like the windfall from the pandemic comes down or end. Then also we have quite a lot of large supply in metropolitan area, which means some strong market may soften slightly or slow down. Then possibly those not very competitive property may start to feel the pain. That's why we wouldn't recommend for new entrants to try to acquire logistic facility at very sharp price at this moment. About office, it's still very much sought after, which is very popular asset class. So if we go to page 8, this is our sector outlook in office. So despite the pandemic or subsequent increase in telework, office sector remains very much sought after. But on the other hand, investors have become more cautious and selective, or in terms of especially location. For example, like offices is great location. When those opportunities pop up for acquisition, or it attracts a lot of attention from the investment community. On the other hand, offices without good access to transport, many of them struggle to the low, strong investors' appetite. So overall, in our view, office demand from leasing point of view remains stable in Tokyo CBD. Of course, there are some effect of like telework practices. So most likely, office demand will shrink, but at the most by a few percentage points. But on the other hand, there should be some demand, for example, like satellite office, which are close to residential house for those who don't go to central office every single day. So those new demands are appearing now, and in our opinion, which should account for like few percentage points in the near future. So overall demand of office demand should stay similar or the same in our opinion. Then, talking about residential, go to next page, page 9. So residential is very much sought after asset class globally, and here in Japan, no exception. So that's why cap rate keep compressing at this moment, probably to early 3%. And also it's a challenge to acquire assets, especially portfolio, because of too many competition and too many bidders. And pandemic has changed two things significantly. First, size preference. So of course, now the larger the better, because many people don't go to office every single day. And at least we can say everyone spend more time at home. So that's why larger apartment in more demand. And also due to the pandemic, affordability gains more momentum than convenient location or central location, which means the rent in central area soften more than affordable area. So we have seen those to trend. But the second one, like location premium, seems like we started to see some reversal because pandemic now reaches endemic state, and many people started to come back to central area. So far, we have seen the recover of rental level of residential property in central 5 ward, like by 50% from the trough to current level for central 5 ward, and 25% recovery for Tokyo 23 ward. So we will see most likely more recovery, and especially in central 5 area. For more suburban area, we may need to pay more attention to how economy goes, because if the wage remain stagnant, it's difficult to increase the rent. So about logistics, I have covered its outlook already. So now we will move to page 12 about office sector. So office sector, as I said at the beginning, still in the adjustment stage, but adjustment becomes softer and softer, and overall vacancy is still pretty moderate at 3%. So overall, which is good, but still in adjustment stage. If we go to page 14, this is yield spread comparison in the Asia Pacific region. So still, financing is available with pretty attractive terms. So yield spread for Tokyo office property are pretty good. That's why it remain very much popular. And if we go to page 15, this is about like vacancy. So as I said, so overall vacancy is as low as 3%, which is good. And somewhat or already kind of like started to not bottom out, but like plateau. For example, Minato exceeded 5% of vacancy before, but now lead came back to high 4 or low 4%. So still in adjustment stage, but adjustment is getting better and better. We hope the market will reach the bottom very soon. And some market already found those bottom. For example, Shibuya. Shibuya is a place where technology company concentrated, which means they were the first to return the office floor at the beginning of the pandemic. But now they already started to come back. So that's why Shibuya's, or especially convenient area, near station area, already rent started to increase and vacancy became back to zero again. So all other sub-market need to find those equilibrium point to take off. So if we go to page 16, this is about like rental level. So as I said, so Shibuya it's also a good area or already started to recover. And as you can see here, yes, still kind of like adjustment stage, but adjustment is really depends by sub-market. But overall, we can say this adjustment becomes softer and more moderate. So next, I'd like to talk about supply on page 18. So as I said, last year and this year have moderate supply, as you can see here, but 2023 has pretty large supply, which makes some market participants worried. So if we go to page 19, this is where those supply concentrate on. For next year, green one, 3 areas have a lot of supply. Toranomon area, Shibaura Hamamatsu area, Shibuya area. Toranomon area has very 2 large supply developed by Mori Building. I mean, Toranomon Azabudai and Toranomon Huge Station Tower. Those 2 seems already pretty good situation. So I don't think we have to worry about anymore. And about Shibuya, it's basically like Sakuragaoka project, which is very close to Shinjuku Station or Shibuya Station. And that one also, it's very likely to be in good shape within this year. So it means there are demand for those quality buildings. And it's good to know those major projects already have been released or are very much likely to be filled before the opening. Now we have some concern Shibaura Hamamatsu area, and which may start up things in the market, but all others basically go well. So we hope 2023 supply will not create headache for the market, and seems like the office market and so far look like going to good direction. And then I'd like to touch upon some regional cities. If we go to page 20, this is like Osaka office situation. So as I said, so Osaka welcome the new addition of prime building, quality building. It went very well. And if we go to page 2020, this is our supply situation in Osaka. Page 22 is about supply in Osaka. So this year, as you can see here, quite a lot of supply. But fortunately, except in Osaka, all go well. So it's a good sign, encouraging sign. And 2024 has also large supply, which may be a better weather, because those supply concentrate on the prime area in Osaka, I mean Umeda area, and all quality building try to achieve the top rent at 38,000, we believe. So it means very expensive building or very large floor size will come to the market at the same time. Then, if it goes well, that's great sign, but it may maybe change the direction of the market. So it's worrisome for some people. But then maybe it's better for us to remember what happened in Nagoya in 2015. Nagoya had a similar situation in station area. Large supply came together in 2015 against or as contrary to the market participants' worry, or those new addition or supply were well received. Probably supply created demand. So maybe we can see the same thing in Osaka, and those new quality building or transform Osaka prime area before the exposition 25, and then transforming the city to be more attractive. So then that's about office sector. So we will see residential sector next. If we go to page 25, this is like listed rental trend. As you can see, we have seen some recovery, like reversal from the pandemic. So 50% recovery for central 5 watt and 25% recovery for 23 watt. And if we go to next page, 26, this is about occupancy. Occupancy also recovered and still 1% lower than the pre-pandemic level, but already quite good shape. And then I talked about like some like, if we go to next page, page 27, this is like area difference. So what we could see here, during the pandemic, central area, the value decreased, but already started to recover pretty strongly. And also some affordable area where showed strong growth during pandemic seems like softening now. So it means we are seeing some sort of like reversal from the pandemic. And also on the right-hand side, we can see larger unit or preference remain and continue. So finally, I would like to touch upon prospect about 2030. So maybe 2030 is too many years ahead. Many of you may retire happily already. But we predict steady growth in Asia's largest real estate market, Tokyo, continue toward 2030. If we go to page 29, so Japan's socially, politically, economic stable condition together with like attractive funding continue to attract international capital. And the population in Japan is aging and shrinking, but the population of Japan, Tokyo, remain very similar or pretty good level, at least for next 1 decade. It means also Japan stay the major economic power for next 1 decade. And quite a lot of like supply pipeline in all city, in all major city, not only Tokyo or major city like Osaka, Nagoya, Fukuoka, which should keep transforming all cities more attractive. And there are some concerns, like for example, like inflation or interest hike. Maybe it's more worrisome for Japan because public debt level is very high. But on the other hand, if we look at our debt level overall, I mean, including our private sector, which is not the highest in the world, among the highest in the world, which looks a little bit more manageable. So from here, I'd like to show some data or figure to support what I just said now about the prospect about 2030. So first, page 30, this is about global population. Also, 10 years later, Japan is no more top 10, but still top 13, which is pretty good given the GDP per capita. still Japan is definitely one of the major economy, at least for like the next 10 years. And then if we look at page 31, this is about like city ranking in terms of population. Tokyo shouldn't be no more the largest metropolitan in the world, because India or Chinese city are growing very rapidly, but still Tokyo, Osaka in top 2 and top 10 level, which is great. And another thing is page 32. So Japan's economic growth in general doesn't look very good because growth is pretty modest. But now, previously, like growth like emerging economy, especially big one, BRICS, significantly slow down their growth for last 1 decade, which make Japan growth better in relative terms, because everyone slows down. And finally, page 33, this is about like debt level, including private sector. So Japan's debt level on public side definitely worse in the world, but private sector very moderately level. So overall, it's not the worst in the world, among highest, which should give us some comfort. And finally, page 34, this is a map of next development plan in Tokyo toward 2030. So we have a lot of plan, and not only Tokyo, but also major cities. So it means Tokyo can keep transforming itself to be attractive, and it should be a great investment destination toward 2030. That's all my presentation. Thank you very much for your interest. Thank you very much for your time. I hope you enjoyed and you find it helpful for your investment decision. Thank you. Bye.
Thank you, Mr. Tetsuya, for sharing the investment trends in Japan. So in your presentation, starting with the macro market summary, the slow growth is due to global uncertainty. So in real estate market, we all know that COVID-19 impacts start to emerge, including different kinds of sectors like the office, retail, hospitality, and emerging assets. So you also mentioned that the grade A offices at certain locations will also perform strong and very stable, just like Hong Kong market. So when talking about the residential market, you mentioned that in your presentation, the great challenge for now is how companies will adjust their remote work policies in a post-pandemic world. So I think Japan is not the only market that is faced with a great challenge that the pandemic brings to us. Thank you. So now come to a break. The break will last for 5 minutes. So please come back and join us with the insightful session after the break. Thank you all. Welcome back. Thank you for all of you coming back after the short break. I hope you all enjoyed the previous session that focused on Singapore, Hong Kong, and Japan. So we will continue to introduce the next session, Investment Spotlight Korea. The speaker is Ms. Soren Jae at Cushman & Wakefield. Soren focuses on cross-border investment and domestic office transactions with her business expertise obtained from various real estate-related professions, including asset management, development, investment, and consulting. So welcome.
Hello, it is my pleasure to be invited here and talk about Korea's real estate market. So many things have happened just short period of time recently, and I'd like to explain what is actually happening in Korea real estate market. The title says unsettling, but not because the Korean market is unstable or risky. But the market is giving out mixed signals, like positive side and negative side. So I'll explain about the capital market environment, and I'll explain more in details in office and logistics centers. Okay, as you already know, the interest rate hike that shook the financial market to the cope with the inflation is impacting everywhere. The Korea is no exception. In just 12 months, the benchmark rate went from 0.5% to 1.75%, which is 125 bips higher. And it is no surprise there will be another increase. Actually, it is to be announced today. So far, the economy itself is doing fine, but there are some signs that might affect its real economy. However, there are positive sides as well. The Korean real estate market is still healthy with the rental market for office logistics. They're very strong, and there's still liquidity over real estate. Also, our real estate financial market has matured over time in Korea. So many investors are seeking to find investment opportunity in Korea. So we'll start. First is the trends in GDP growth and unemployment rate. The Korean GDP growth has been very stable compared to other countries. It was like in 2020, it was like negative for everywhere, but it went bounce up, and then it looks like it's gonna be stable like before the COVID-19. And the unemployment rate is actually reducing as well. But one negative sign is the trade balance, the export and import balance. It was all positive, although there was a COVID-19 and everything. But in June this year, it shows a negative index, which is for the first time after the 2008, which was the global financial crisis. The monetary market has been growing continuously until 2021, with the interest rate is going down, but with government policy increasing the rate, its increasing trend looks like it is going to take the turn. But still, the overall liquidity stays higher over pre-COVID level. Now it's the 5-year treasury is 3.38, which it was lower than almost like 1.5 or 7, but it's almost double right now. With that financial environment, office transaction market has grown to the annual volume of 10 trillion Korean won. It used to be 4.5 trillion won 5 or 6 years ago. And last year, it went down from the previous year, 2020, after there were like consecutive years of increasing. But however, this year, we have IFC, a huge deal, more than $3 billion, and other office deals, or large office deals like Jono Tower, Concordian, or and Shinhan Financial Group headquarters. So the transaction volume will catch up this year. For the logistic transaction volume, it was about 7.7 trillion Korean won, which is 7 times larger than 7 years earlier. Most of the transactions are held in Seoul metropolitan area, and it is expected to increase as there are a considerable supply schedule. One of the reasons that made it possible for the market to grow in volume was the indirect investment vehicle like real estate fund and REITs. If you see the graph of AUM of REF and REITs for the last 10 years, it grew by 7-fold, reaching 213 trillion Korean won. And the recently, REIT is drawing attention. There have been REITs, but they're more interested in REITs and listed REITs. Actually, as of last year, there are 18 listed REITs, and the volume is about 7.4 trillion Korean won, which is like huge jump increase. Now I'd like to talk about the office market in detail. So cap rate and price, where will it go? So a lot of people ask me about the cap rates. It has been compressing since 2016. It was going down and down. It was accelerated due to the low interest rate, giving out the spread of more than 300 bips between the benchmark interest rate. But however, it has narrowed less than 200 bips. But the price level have been maintained because of the market environment that made NOI higher. Historically, before the global financial crisis, the price went up, NOI went up, and cap rate went down. So the market was going very robust with price going up, and everything was by the textbook. But after the global financial crisis, price went up, but the NOI stayed. It looked like it was increasing, but there are a lot of rent-free giving out to the tenants. But the price went up because of the cap rate was going down. But right now, the NOI is going up, but cap rate is, I think it will eventually go up. Right now, still cap rate has not been moved a lot because NOI's increases is tremendous. So the prices stay the same, but going forward, I think it's gonna be, there will be a little bit of adjustment. With that, speaking of cap rates and the cap rates and the interest rate spread, I've compared with some major cities in APAC. Korea had been one of the favorable market with more than 300 bips like spread, like Sydney as Tokyo. But right now, just from from last year, it's below the average of 198 bips. But why it's still attractive city to invest? The market fundamental is really good. I'll tell you more about in this slide. The vacancy rate, the Seoul office market is enjoying the historically low vacancy rate right now. The overall rate is 5.9%, which is nearly the just natural vacancy. And for the area like GBD, Gangnam area or Pangyo, it's like saturated. There's like no vacancy. So with low vacancy, the rent is going up. If you see the graph on the left, from 2018 to 2021, the rent increase seems be really slow, but from just this year, from early this year, just and the May or June, it just ramped up. So that's how strong the market is. It is backed by an additionally because of the limited supply. Seoul's office market supply is about like from 2011 to 2018, over the 7 years, the average supply is 75,000 per 7,000 pyong, and that had been observed for a long time. And from 19 to 21, just last 3 years, the supply was huge with 100 to 120,000 pyong, but it was all observed. So that's how much the demand was there. And going forward, we have little supply planned, but with those planned supply, it looks like it's gonna be delayed because of this financial market and the cost going up. So this is the trend of the office price per unit, per pyong. So we spot down the highest unit price in the year. So we spot down, and it was like similar until 2017, but it was going up, and it almost doubled the price until in just 4 or 5 years. However, I don't think it's gonna continue to go up again, go up more, but it's gonna stay. So, and now it's the industrial market. As you can see, the market fundamental is strong with the demand. Demand coming from the e-commerce. The revenue continues to grow, and the logistic companies' performance just doing really good. I guess this is the same as everywhere in the world. And in supplies side, based on the demand, the supply has grown as well. The supply is mostly concentrated near the Seoul area. Actually, there was in 2021, when you compare to 2020, there has been 43% increase in supply in logistics. So, I mean, you can see how the supply is following the demand. Up until the Yeah, sorry about that. It's the logistic market. It just 7 years ago, it was only around the Seoul area, and then the transaction volume was very small. It was, if you see the blue area, it's just south of the Seoul and a little bit of western of Seoul. But last year, the number of transactions grew, and then the spotted area, it just spread out. It was just concentrated around the Yongin, Icheon, and Incheon area, but it just spread out, and you can see not just the Seoul area, but the all southern areas, they have logistic transaction happened. Until very recently, I got the question about the cap rates about the logistic market, and then the cap rates, it was just like went down, like shrunk abruptly, and it just near the cap rate of office, and it was almost low as a 4% till now. But the interest rate going up, and then supply going putting in the market a lot. So those are going to cool the market a little bit, and then continue the interest rate rates will raise up the cap rates a little bit. Also, there's a trend in logistic market, actually, because of the interest rate is going up. The investors are asking for higher yield, and then the development cost has gone up because they bought at they bought the land at very expensive, and then construction cost has gone up because of the inflation, and then labor cost has gone up as well. And then there are safety law, there was strength. So they'll have to have a longer period of construction period, which is also costs going up. And the financial cost, and obviously has gone up, and the operating cost has gone up due to the labor cost and all the inflation as well. So there'll be a lot of pressure on the tenants to pay more rent and more fees. With that, the logistic market, we have categorized the area into 5 districts. Traditionally, the number 1 and number 3 has been the most popular area for the logistics because of it's the access and the infrastructure. Although there will be still ample demand for logistics, some of the new cold storage will suffer from oversupply because a lot of developers start to build cold storage because cold storage has higher rent, but because of the cold storage has limited demand, so there will be a little bit of an oversupply of a cold storage. And then new constructions will suffer from the cost. I mean, I explained a lot about the construction cost and the interest and financial cost. So a lot of investors will focus on the existing and dry logistics centers. And then, although it has started spread out over the country, but they will come back to the core asset and core location as well. The market is going through inflation and interest turbulence, so the core asset will be the target for the investors. Some of the foreign investors have not been very successful in Korean real estate market because the domestic investors were just too aggressive. But right now, I think it's a good time for foreign investors to get into Korean market if you understand the real estate fundamental. And then if you have a right partner, I think it's a really good time to come into the market. I think a lot of investors have questions about other sectors as well. Residential, life science, or self-storage, or data centers. The market is actually still nascent for institutional investors because there are less data available. And then for residential or life science, there are a lot of government intervention, and self-storage. It's actually the individual, the very small in scale. So for institutional investors, I think the market is too small for now. If those are for developments, it is maybe considerable, but it's still a little very early stage. Well, hopefully there will be another time to discuss those markets, and I'll finish my presentation now. Thank you.
Thank you, Soren, for the sharing. So you have mentioned mixed signals of the market, and for real estate indirect investment, one of the emerging signals is rates, and real estate funds emerge as a leading indirect investment. And in the logistics sector, the demand is really strong thanks to the e-commerce industry. So when looking beyond, you also mentioned about the changes and challenges for the logistics section. So it's really an informative presentation. So after Korea market, now come to the last key focus market for today. The next session, Investment Spotlight Australia, is presented by Mr. Samir Chopra. Mr. Samir Chopra is the head of the research in Pacific and ESG Asia Pacific at CBRE. So during this session, you may ask questions by tapping at the chat box. So welcome.
Great, thank you, and good afternoon. Hope everyone is doing well. I'm going to spend time talking about a couple of things. One is, what's the economic outlook in Australia? How does immigration drive the economic outlook in Australia over the next couple of years? What drives investment returns in Australia? Talk about what's going on with interest rates and how we expect that to sort of affect bond pricing and then into cap rates. And then sort of close out by looking at some of the trends we're seeing in office and in industrial. And I'd like to sort of finally touch on, some of the ESG considerations as well. So, Susan, with that, I might just kick it off. I might go to the next slide after this. So if you think about Australia, historically, there's been about 230,000 immigrants that have come to Australia every year. That's kind of the historical run rate. And the population of Australia is 25 million. The last 2 years has been tough. 2020 and 2021, the borders were shut. We were losing people. And now the borders are open. And people are starting to come back in, and migration is slowly starting to trickle back in. The bar chart in the front of you is the government's projection on migration over the next 3 years. So, like I said, 230,000 per year was the previous average. And now over the course of the next 3 years in total, we'll get about 490,000 migrants in total. What does that 490,000 mean, and why does it matter? Because that 490,000 migrants means another 900,000 square meters of office demand. It means about 2.2 million square meters of incremental logistics demand. You know, it puts 200,000 roughly demand for homes, and about 7 billion gets spent on retail. So migration is a big driver in the economy, and it's been absent for the last 2 years, and it'll start to kick back in. And I think that it helps with rent growth in the market in particular. Susan, I might go to the next slide, please. So just looking at, you know, what's kind of the outlook for occupiers. We have a large presence of multinationals in Australia, and these multinationals plus Australian companies are in pretty good shape right now. You know, revenue growth for the multinationals is running at 10%, and you know, even within Australia, the mining sector in particular is in very good health right now. Very few people sort of appreciate, I think, that Australia is the 4th largest LNG producer, gas producer in the world, and one of the largest exporters of gas. So, you know, these commodities are sort of helping sustain occupier sentiment. And so we think occupiers are in pretty good shape. And, you know, that helps. It helps in office and it helps in logistics. With that, I might just go to the next slide, please. So now just sort of unpeeling it, what's kind of going on the ground. There's 2 charts in front of you. The one on the left-hand side shows job vacancies, and the one on the right-hand side looks at retail spend. The job vacancies, you know, in a good month, previously 130,000, 140,000 job ads was considered a good outcome. And, you know, during COVID, it dipped, and then it came back out, and now it's become really, really hot. We've got about 220,000 job ads in the market right now. It's almost double the pre-COVID levels. And, you know, it's been at this level now for the last few months. You know, and I say it's too hot. Job ads are too hot. There's too many jobs out there. It's the same picture with retail spend. A good retail spend number in Australia is 3%. 4% is a good number. And, you know, in the month that's just gone, the number was 10.4%. In the previous 2 months before that, it was 9.6%. These are good numbers, strong numbers, but they add to inflation. And that's kind of the problem. So the jobs market is very strong. Retail spend is very strong, but that's driving inflation in the market. And that's pushing up interest rates because it needs to cool down. This is too hot. It needs to come straight back down. With that, I might just go to the next slide, please. So this is a picture on returns in real estate in Australia, commercial real estate in Australia. The lighter colored or the teal colored lines is the income return, and the dark blue line on the top, or the bars on the top, is your capital return. And typically, you know, around a 10% annualized return is what you can typically get in real estate in Australia. The time when we've sort of walked away from that was during COVID, when there was capital depreciation. But income returns, you know, currently are trending at about 5%. So you can get a pretty solid sort of 5% return from income, and then capital is a little bit more sort of volatile on top of that. So I just wanted to paint this picture because when people think about Australian real estate, what I would say is it's steady and boring in some ways. And boring can be fine in today's market. Boring is good. We don't want too much sort of volatility, but a typically good return in the Australian market is, you know, a 10% return is great, of which sort of about 5% comes from income, and the rest needs to come from sort of capital. With that, I might just go to the next slide, please. So, you know, we spoke about this very hot jobs market and this very good retail sales market. But what that's meant is that the central bank in Australia is hiking. It's one of the few central banks in Asia Pac, along with sort of New Zealand and Korea, where we are seeing hiking. Interest rates have increased to 1.35%. Our house view is that interest rates will get to 2.1% at the end of this year and 2.3% next year. The bond market, which is the one just above that line, shot up. And you can see how, you know, it's almost been like a vertical takeoff in bond rates that happened during March and April. And then since then, they've started to come back down. And bond rates right now in Australia, 10-year bond rates are about 3.4%, and it had peaked at 4.1. Our view is that, over time, these bond rates will continue to sort of trend down, and its long-term average is about 2.6%. So what we're saying to investors is, we've got this hiatus right now where investment activity has paused just because the bond curve just went whoosh up kind of thing, and it started to come straight back down on the other side. This volatility in the market has caused a pause and a freeze. But what I would encourage people to do is, if you think about the next 3, 6 months, 12 months out, these bond curves will be trending back down. We think activity will start to pick up as buyers can secure finance at potentially much better prices than they've been able to secure today. Might just move to the next chart, please. So, one part of the equation is that bonds have moved up and are sort of hurting. The cost of finance is expensive. But on the other side of the equation, rent growth has started to pick up. Rent growth was anemic. There was almost no rent growth last year, and those rent growths have started to increase. And this chart in front of you just is a dot plot that shows the relationship between rent and asset price. And each one of these dots is a specific market, like Sydney Industrial, Sydney Office, Melbourne Hotels, Brisbane Retail. Each one of these is a little dot plot showing what is the expected rent growth and then what is the price for that asset. And the reason I wanted to share this chart is because it says that for every 1.5% growth in rent above expectations, cap rates can come down 25 basis points. And this is the tug of war. Bond yields are trying to push pricing up. At the same time, higher rents and growing rents are pulling prices back down kind of thing. And we've got this tug of war in the market right now. And I think that's one of the reasons why there is this hiatus in the market, why there's less activity, because people are waiting to see, who wins, bond prices or rental growth. Might just move to the next slide, please. Just in terms of kind of rent growth, I just wanted to share this picture. Sydney office rent this year, we think will be about 4% growth, face rent growth. Industrial, rent growth could be about 27%. So it's a very good rent growth in Sydney Industrial. Retail sort of flattish, and then residential apartments rent growth is running at about sort of 12%. The interesting thing about this chart is, if I had had this conversation with you 6 months ago, so in December last year, I would have said office rent growth will be +1 to -1 in that sort of range, almost flat. And now we're at 4%. Industrial, we would have said rent growth will be somewhere between 4 and 6%. And now we're at 27%. And, retail, we thought maybe potentially negative. And now we're at low single digits. And apartment rents, I would have said, is 0%, maybe 2%. You got to wait for the migrants to come in before rent takes off in apartments. And now, we're sitting here 6 months later, and rent growth is looking like it's going to be 12%, 15% in markets like Brisbane. So point is that, rental growth is starting to inflect up in Australia in select markets. And, it started small and it's become more sort of broad-based, as you can see on the table in front of you. I keep going back to that point, bond yields are putting downward pressure on prices, and rents are putting upward pressure potentially on prices, because we're starting to see rents inflect higher at the same time. Might just go to the next slide, please. So on this chart is an interesting theme. It talks to flight to quality. We all know about flight to quality, but here what we did is we went back and collected some data looking at what's going on the ground on leasing transactions. So it's comparing the rent a tenant has paid in a building here, and then when the tenant has moved across, we're saying, what's the rent you're paying at the current building? So what's the rent you would have paid here versus the rent you're paying in your new building? And I was surprised. I was genuinely surprised. The rent chart is suggesting that, on average, occupiers are paying about 10% more in rent. It's 10% more in rent in the new premises versus the rent that they were paying in previously. This is just a straight rent change, right? Like, so you could be in building A and then you move to building B, and the rent, for example, is $1,100 in building B, and it was $1,000. So you could have stayed here in the first building and just paid $1,000 per square meter, but you've chosen to move and pay $1,100 per square meter in the new building. What surprises me is, that line at the bottom of that chart, that is 25%. So there's around a third of the market that is quite happy to pay 25% more rent by relocating to a new office. Why? Why is this happening? Why are people relocating to these new offices? It's a couple of things. One is, brand new, nice offices is helpful in attracting new talent. It's helpful in bringing people back to your office. It quite often has good ESG associated with it. But it's also occupiers saying, I want to get very close to my clients. So where are my clients? Where are the banks, for example, situated? Can I get close to the banking firms because I do a lot of business with the banks? So people are moving potentially out from secondary locations and other offices and coming into the CBD core quite often and paying up. And not paying up a little bit, the average is 10%. And like I said, a third of the universe is willing to pay, more than 25% in rent cost. One of the other final things here is, rent is not a big line item, cost line item for a lot of occupiers. In some professional services companies, rent is 2, 3, maybe up to 5% of their cost. So, if rent goes up by 10, 15, 20, 25%, it doesn't move the needle on your cost structure very much compared to the potential revenue opportunities that you have on the other side. And I think a lot of this is coming into play with occupiers. I might just go to the next slide. And what this does is it looks at that same picture I showed previously, but it says, so who are these occupiers? Who is participating in this flight to quality? Which industries, what types of occupiers are doing this? And I think I was surprised as we sort of unpacked it and started to look at them. It's engineering and design companies. It's, in finance sector, it's investment banks, wealth advisors. There's quite a few professional services companies as well, accountants, lawyers, consultants, and they're all wanting to move into better offices closer to their clients with good ESG. So, it's those sorts of sectors where we're seeing this play out very strongly, not necessarily in tech, potentially not as prevalent in government, but definitely in design and engineering, definitely in professional services, and in parts of finance, like investment advisors, wealth advisors. So I think you need to be very selective in the sorts of occupiers that are going to play this theme. Might just go to the next slide, please. So people are paying more rent, but are they taking less space? And this is again looking at our leasing data, and what it's saying is, on the sort of vertical axis is your previous footprint, and on the horizontal axis is your new footprint, right? So, and then the question becomes, if someone has taken up, so this is not a survey, this is real data, real leasing data. Same with the last chart, it was not a survey or intention, that was like live leasing data. On this one, as you look at the dot plot, it says that actually, most people are broadly sitting close to sort of flattish space. You can see that along the line. But tenants who are less than 500,000 square meters in take-up, those people are actually expanding their footprint by 7%. So the small and medium-sized occupiers, they've experienced good growth during this sort of COVID period, and they have taken up more space. Like I said, you can argue about it, but this is not a survey. This is not an intentions. This is like real leasing data. And the stuff on the ground is basically telling us that people want to take up more space and are taking up more space. So footprint is expanding, but you need to sort of focus in on the smaller, medium-sized businesses, people that typically take up 5,000 square meters or sort of less. Might just move to the next chart, please. So that was office, and then now just looking at the logistics picture. And this looks at demand and supply. Looks at gross take-up. So gross take-up in Australia, last year, crossed the sort of 4.5 million square meters. It was a very good year last year, and it's been on an upward trajectory. On the flip side, you've got the supply side in logistics, and there's a big mismatch between demand and or take-up versus supply. Supply is running at about 1.5 million square meters, compared to, like I said, demand running at that sort of 4.5 million square meters. What that means is that vacancy has tightened, and now vacancy is sitting well below 1%. And when vacancy is sitting that tight and below 1%, that 1% is an average, by the way, means that there are precincts where vacancy is super, super sharp. There are precincts where it is very hard to actually find space if you needed space. What that means is, it then eventually starts to drive up rents. And as you saw in that previous chart I showed, rent growth in Sydney Industrial in the first half of this year was running at about 20%. After being sort of, low single digits, it's kind of gone 20% in the first half of this year. Just something to bear in mind that, you reach a point where vacancy tightens so much that rent can increase. And the point, same point I was making in office, rent is important, but rent is a small component of the cost structure for many businesses. What's more important for them is, where they're located and how close they are to the end customer. And that's what will drive their sort of rental performance. I might just move to the next slide, please. So, I started the conversation by saying, with this big increase in bond rates, and it's been up and then down sort of thing. So bond rates went from, around 1.3, 1.6 level, went all the way up to sort of 4% over 2 months, and have come back down by about 0.6, 0.7% in the last 3 weeks or so. That volatility has meant that investment markets, have paused for now. And you can see that in the activity chart that I've put in front of you. This is total capital markets transactions that are happening. In the first half of this year was a slower start. We were back towards sort of pre-COVID type transaction activity levels. Nothing too dramatic. It's just a return back to normal. It's also because there was fewer portfolio deals being done. But I think what was interesting about the first half of this year as well is that last year there was a lot of logistics activity. This year we've seen quite a sizable office activity. Office makes up about close to 55% of the transaction activity in the market. So there's been a sort of, call it, return to normal in that office makes up about half of the transaction activity in the market. Let's just move to the next slide, please. Coming towards the end of my presentation, but I wanted to talk about 2 or 3 other things. One is asset allocation to real estate. And this chart in front of you just shows you, how much, what is the level of asset allocation to sort of real estate. The black bars is the allocation by Australian pension funds. And the teal colored lines is the allocation by funds in US, Europe, and Asia Pac. And it's for funds that have made public disclosure. So, if a particular large pension fund has made a disclosure about how much asset allocation they have to real estate, we plot that as a bar chart over here. The point I wanted to make here is, in Australia, the allocation to real estate is sitting at 6 to 8%. And in some Western markets in Europe and the US, allocation to real estate is sitting at 10 to 15%. And we know that real estate is a very consistent performer, particularly from an income perspective. So I would expect, and this is not going to happen over a short period of time, but over time there is a case for a larger allocation into real estate. And in fact, the allocation to real estate could potentially double over time if Australian pension funds were to follow some of their peers in other markets. You could get quite a sizable increase in sort of allocation towards real estate. What's going to drive that? I think multifamily is going to be a big potential driver. If and when multifamily market develops, then that could be a big driver of allocation towards real estate. I'll just go to the next slide, please. So this is the last couple of slides, and they talk to ESG. I'm a strong believer in ESG, and it's something I do day in, day out. Sorry, excuse me. I wanted to show you a couple of charts on ESG. This is, people often think, if you have an old building, it is hard to get a good ESG rating for that old building. Here, what we did is we went back and looked at office buildings in Australia that were constructed pre-2000, so buildings that are now, more than 20 years old. And we compared the age of the building against its neighbors rating. And neighbors is a way of measuring green for an office. So it's the energy efficiency. A 6-star is very good. And then you get 5-star, 4.5, 4-star, 3.5, 3-star, etc. And I think, when I did this analysis, again, it sort of surprised me that almost a quarter of the buildings that were built pre-2000 have now been upgraded and are 5.5 or 6-star rated. And so the point I want to make with this is just because you own an asset that is, call it old, or has been there for more than sort of 20 years, does not mean that you can't fix it and ensure that you can improve the ESG performance of that asset. And as the data here suggests, almost a quarter, 24% of the assets that were built pre-2000 now have a 5.5 or 6-star rated, neighbors rating attached to it. The next chart, please. And I probably have only another 1 or 2 charts to go. Similar thing, so this one also has the ESG ratings at the bottom. So your 6-star, 5-star, 5.5-star, and then it has the occupancy. And what you can see here is that, buildings that are 5.5 or 6-star rated typically have an occupancy of 94% per the data that we have. And when the ESG rating sort of falls away, or the neighbors rating falls away, the occupancy in those buildings is about 83%. The reason I want to present this chart and the next chart after this is if someone is looking to build a business case around improving energy efficiency in a building or improving an ESG quality, this can help you construct that business case, because it tells you, you can get an occupancy lift if you improve the ESG rating of a building. And if you want to know what the numbers are, this is a handy chart. This is a pretty decent sample sizing that we did around office structures in Sydney, Melbourne, Brisbane, Perth in Australia. And just going to the final chart, please. And on this one, we just show the rent versus the ESG ratings. And what you can see is, buildings that have 6-star neighbors rating currently have an 8% rent premium in the market, and buildings that are sort of 3.5, 4-star rated, we're finding can have up to sort of 6% rent discount in the market. So just like we were talking about better occupancy, you also get rental differentials in the market, because the 3 parts of the business case are lower energy costs, better occupancy, and then the third one is better rent. And together that should drive a better cap rate from putting in the investment improve your ESG. So look, with that, Susan, thank you. I think I've come to the end of my presentation. If there's any urgent questions, please sort of yell out. I have one question, which is, what could be the impact to the Australian office market if the US goes into a recession? Couple of things there. I think one is Australia has a high prevalence of US occupiers, financial services companies, some consultancy companies, but also some healthcare companies. So there could be a pullback in some of the hiring in that market. But what I would say right now is, we have 220,000 job ads, which is what I'd shown previously. So it's a question of, like I said, that is too hot. That is way too high. If that number was to come down and come back down towards 130, 140,000, I think that would be fine. So we can afford to take a little bit of pullback in job hiring. In fact, that's what the central banks are trying to do. They want to cool down the level of hiring that's going on in the market. So let's see if they're successful. Great. Look, thank you everyone for taking the time to catch up with me, and thank you, Susan and APREA, for hosting me.
Thank you, Samir, for the insights shared in the session and your explanations to the question. I would also thank all the speakers that has conducted the speech in today's session. To make a summarize, in today's webinar, the professionals have shared how the global mega trends affecting investment opportunities and what are the innovative funds, strategies, and solutions that can help the investors capitalize on market changes and generate long-term returns. So it's truly an informative webinar. So now comes to the end of today's session. Please join us in the second day of the webinar, which is tomorrow afternoon. So we will talk about the latest research and insights on investments in other key markets in Asia Pacific region. So thank you all and see you tomorrow.